Good morning, everyone. Welcome to Monday Minutes. We're off hot and running here Monday morning. We're going to take a brief look back to Friday. The employment number, obviously a big disparity between the household survey, which is where the unemployment rate is calculated from, a tick up to 3.7. Certainly a welcome sign for the Fed. And then on the establishment side, the birth-death model, adding 200,000 plus jobs per month. That number obviously coming in stronger than expected. If you look at the job growth there, certainly within the services ex-housing component, which is clearly where the Fed is concerned that inflation still remains sticky. So really, and wages coming down a little bit. So something for everyone there with regard to Friday's number. You know, with regard to the Fed, we still remain, despite Friday's number, we still remain in the, call it pause, skip camp. But certainly I think the message is pretty clear. If the Fed does decide to take a pass next week, they will certainly signal this is not the end of the tightening cycle, potentially. And in conjunction with that, we do get another SEP, Summary of Economic Projections, which we think will show an even higher terminal rate than we had last quarter, which was at 5.1. So potentially another rate hike, unlikely for 2, but at least one more rate hike. And when you look at pricing right now, 25% for 25 roughly in June, and certainly another full rate hike priced in by the end of the July meeting. The volatility indices, we look at Friday, we look at markets in general, getting past the debt ceiling, the rate structure is still very low, the Fed potentially forming a new cadence here, if you will, the skip cadence, which is really nothing new to Fed policy. But if you look at the MOVE index, you look at the CDX index, MOVE being Treasury, CDX being volatility with credit, and certainly if you look at the VIX, all volatility indices coming down very strongly. We know risk assets do enjoy lower volatility environment, and that's certainly what we had short term. We're not seeing a tremendous follow through today, but certainly the markets enjoyed some fine performance on Friday. So the debt ceiling. So we've got this thing called the debt ceiling now behind us, right? The real work, though, potentially is in front of us. And what we mean by that is when you look at the liability side of the Fed's balance sheet, we know the asset side, we've got treasuries, we've got mortgages, any sort of bank lending that comes from the Fed. Obviously, if the Fed is lending money through their 13.3 programs, that would fall on the asset side of their balance sheet. If you look at the liability side, we've got the Treasury's general account. So take your checking account, whatever bank you have it with. The Treasury has their checking account with the Fed. It sits as a liability, obviously, for the Fed. And then we've got reverse repo, okay, where money market funds, for the most part, are lending cash to the Fed, earning a very, very decent, safe return in conjunction with collateral exchange. And then certainly we have bank reserves. So now what we're going to see in the ensuing months is a slew of issuance coming from the Treasury as they try and replenish their general account, right, to pay the bills for the United States government. In conjunction with that, and let's call it anywhere from $750 billion to $1 trillion in the coming months and quarters of new issuance, will certainly then be draining money on one hand from the reverse repo facility as this collateral hits the marketplace, and then in conjunction with that, bank reserves. So despite the fact that risk assets are performing very well right now, we do think in the coming quarters it will make sense to pay attention to the liability side of the Fed's balance sheet as liquidity gets drained from the banking system and vis-a-vis will impact certainly risk assets in the second half of 2023 in conjunction with potentially slowing data. The rate structure. We've seen better buying in general, in particular 5 years and under, with any sort of backup in rates that we've seen recently. We know we've had a fairly decent repricing, in particular on the short end of the curve. We've seen that in further yield curve inversion, and part of the repricing in 2-year yields is certainly taking out some of the rate cut premium that was built into the marketplace in 2023. So we have seen a decent backup there. We still believe that accounts will use yield backup from here. If we look further out the curve, call it anywhere from 3.75 to 4% in nominal yields. We look at real yields in 10-year space at 150. If you go back to 1990, we're right on the average right now at 150 in real yield space, but we still think accounts will use any yield concession here opportunistically to add duration. Now keep in mind, we've loved the very short end of the yield curve. If you look at the very, very short end of the yield curve, yields look extremely attractive in Treasury space and in credit space. The challenge there over time is if the economy does continue to decelerate here, and we do in fact move into a recession, and we do in fact move into a rate environment where the Fed is cutting rates, call it late in 2023 into 2024, there is reinvestment risk, and that's something to keep an eye on, and that's why we think, at least further out the curve, accounts will use that backup in yield, whether it's credit, whether it's treasuries, to opportunistically add to duration. And then lastly, hot off the press this morning, ISM services at 10 o'clock. The ISM number slightly over 50, now decelerating off its highs. Probably more importantly, ISM services paid. We haven't seen these levels since the pandemic hit in 2020. It further ignites us to be in the camp here that the Fed is probably inclined to take a pass at this meeting. But if you look at the manufacturing versus the services side, it's really been the manufacturing side of the economy that's been weak. That's been a known story. Where the inflation is coming and where the Fed is concerned is on the services side. So today's number is proof that the services side is in fact beginning to correct and converge a little bit more toward the numbers that we've seen on the manufacturing side. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of US rates for AmeriVet Securities.